Hey guys, Toby Mathis here, and today we want to talk about the crushing U.S. debt, what lies ahead, and what you can do about it. So the number one thing is let's talk about what is the national debt, how much we owe as a country, which is over $34 trillion, and I'm not making that up. That is really the number, and it's growing by about $1 trillion every 100 days or so. It's continuing to get worse. And why is that? Well, it's because we're spending more than we bring in, which we'll get into in a second. I want to really point out, though, is that when you have debt, you have to pay something on that debt. The U.S. is no different. We have to pay interest payments. And with interest payments really high right now, guess what's going to happen to that cost? Well, this is what it was before. This is what our interest rate payment is. It's about 11.6% of the revenue that we derive, or excuse me, of our budget, because we actually spend beyond. But let's just say that $5.5 trillion is what they're projecting that we're going to pay, that we're obligated to pay. It's probably going to be closer to $6 trillion. But even then, it's like we're right on par. Net interest is right up there with what we spend on health and national defense. They're saying it's going to be beyond even Social Security, like it's potentially going to be our number one line item here in a couple of years, which is very problematic when you're spending your most money that you're spending that's bringing in on interest on your debt. Just think about this: if this was a family and your biggest expense was paying the interest on your credit card bill, that would be a problem. Now, how do we get into this situation? Well, we have this deficit. And you can always look up. I just go to fiscal data at treasury.gov. And I like to just say, oh, okay, what's the amount of deficit that we're running right now? When I say deficit, this is the amount of money that we're spending that we're not bringing in. Put it in another way. Here's how much money we bring in, total revenue, and how much did we spend? Well, we spent $6.1 trillion. We brought in 4.4, which means we had a $1.7 trillion deficit. I know there's a lot of you guys out there that are like, this is doomsday scenario. What the heck's going to happen? I'll go over that in a second when we start talking about what lies ahead. But I want you just to get a good understanding of what's going on, especially when politicians start saying, I cut the deficit. Okay, so you're still spending more than what you make, but you're spending less now comparatively versus last year. Well, let's look at that, right? Here's when they're talking about, hey, I cut the deficit. It's because we were running at a greater than $3 trillion deficit a couple years ago. But what's really interesting is, other than 2001, I'm just going to put last year, we had a surplus. All you Clinton fans out there can rejoice. What it meant is that we collected more than we spent. Every other year, for like 20-something years, we've been spending more than we generate. And that's why you have so many people that are alarmists saying we can't go on forever like this. We are going to be in some deep doo-doo if we don't make corrective action. Let me kind of spell out the numbers again, just to make it clear. We generate revenue of about $4.4 trillion. We had expenses of $6.1 trillion. This is that deficit. When I say $1.7 trillion deficit, this is what it is. We have debt of $34 trillion, of which we're going to be making interest payments here pretty quick of about $1 trillion a year. Now, some folks might say, but the U.S. has a ton of assets. I know that our assets in the U.S., if we add up all of our citizens, we're worth what? And by the way, if I just divided that by 340 million citizens, we each have debt of what, about $100,000 on our head. But some people are going to be like, oh, but we got trillions of dollars. We're like 123 trillion, I think is the last time I looked, of assets. But the U.S. government doesn't have that many assets. We have a lot of liabilities. This is the amounts that we owe going forward. These are commitments we made. In other words, people pay into Social Security, for example. Well, we spent the money, but we still owe them the benefits. unless Congress starts taking those away, right, which would be disastrous. But we have federal employee benefits, federal debt and interest payments, there's other, and then here's our total assets. It looks like we have about $5.5 trillion. Woo! Right? I don't know if it's going to make you feel better. It doesn't make me feel much better. Makes me think, okay, something's going to have to happen. Now, there are arguments all over the place, right? How do we fix the deficit? How do we fix this problem? Let's just kind of go through and look at the numbers that we have. Like here's our revenue number, for example. Can we make this go up? Possibly. So that's one of your options, right? We could raise taxes. Option number one might be raise taxes. The problem with raising taxes is that it lowers our GDP. That little GDP number, that percentage of GDP, right? We may not want to raise our revenue and have this come down. They tend to do that, right? We start, you always see this from the government accountability offices and things like that when they start running projections. If you raise these taxes, what is it going to do to GDP? Now you know why that's important, because it lowers how much we're making, even though we think we're increasing our revenue, and it hurts the economy. People start making less. They're not too pleased, right? And then all of a sudden, you're taxing them out of prosperity. They can't bear, they can't afford things. So that's number one, raise taxes. Number two is raise GDP. Ooh, what does that mean? Well, there's lots of innovation. There's lots going on out there. Continue to grow our economy, continue to grow on the world stage, enter new markets, do whatever you can to get that GDP to grow. So as a percentage, it could stay the same, but the tax revenue comes up as a result. And all of a sudden, your debt doesn't look so bad as you're growing. Now, this is the reality, right? Is if you start doing the GDP growth and you start seeing lots more prosperity, what happens to prices? They start to go up, right? And then you have the Fed stepping in, raising interest rates. Like they've been cooling down our economy, trying to stop inflation, and we see what actually happens when they do that, right? Everything's going bonkers as far as expense, but all of a sudden your debt's a lot more. And what does it do to us? Well, let me just go to this equation. It's that interest. All of a sudden our interest payment, if they have to do it, if we get too hot, then all of a sudden you're going to see them raising interest rates, and that hurts us as far as what amount we're paying. Now, I will say this. The U.S. government can't go default. They can't, because we just print more money. But what would that do? We start printing money like crazy. It's going to drive inflation. It's exactly what occurred during the pandemic. If you look at the M2 money supply and you overlay it with inflation, you'll see that they're directly related. And we don't want to be in a situation where we have all these liabilities, and the way we fill that gap is by print money. If we start printing money, what are we going to have to do again to slow down the economy? You're printing a bunch of money, just like you did during COVID. What happened? Inflation went nuts. How do they combat inflation? They raised interest rates. They raise interest rate. What happens to the government debt? You have to pay a lot more on it, and all of a sudden it becomes your number one line item for expenses, right? So there's going to be some sort of combination of these things that are going to play out. So, again, you could kind of look, say, what's likely to occur. You're probably going to see a kind of a structure between three things. You're going to see them continue to print more money. They're trying to combat inflation with the interest rates. Eventually, they're going to have to start lowering that interest rate so as not to pull down the GDP. You're going to probably see taxes go up. That's just logic. They need to generate more revenue, but they don't want to slow down that GDP, so they got to be very careful there. And you might see some attune of whether they can do any sort of restructuring of that debt when the interest rate's low, whether that's going to have an impact on it if they start lowering interest rates, whether that's going to be the time that the U.S. takes any sort of action to try to lower the amount of interest that they're exposed to. Truth be told, nobody's been asking very responsibly. Like, we just look at the amount of deficit we've been running for all these years. It doesn't appear that anybody's taking it too serious, because, again, they have a printing press and they can just continue to print money, so it's obviously not their greatest concern. But when they do print that money, we see what it does to society. It makes things very unaffordable. We're living through that now, and they have to take action. The Fed takes action to try to drive down that inflation and combat it, which costs us a lot more. It's kind of a vicious cycle. So what's going to happen? Anybody's guess, but what would I be doing if, what would I advise clients to do? I'd say you really want to have things that get bolstered by inflation. It's highly likely that that's going to continue to go on, and I mean, pretty much 100%. Inflation is going to continue to be a problem. And what does inflation do? It makes assets worth more money. What does it do to your dollars? Makes them worth less money. All of a sudden, the spending power of your bucks aren't so great. Maybe compared to other countries, you're okay. But in the U.S., if your money's sitting in a checking account, for example, it's losing value. If your money is sitting in the stock market, chances are it's been growing, statistically over time, it's been growing quite well. If it's in real estate, it's been growing quite well. Versus if you had, let's just use an example of, let's say in 1970, you put $50,000 in the stock market, $50,000 in real estate, and $50,000 in U.S. dollars. What would be the spending ability of those items be now? And that $50,000 would be a fraction of what it used to be worth, whereas the stock market would be way up and real estate would be way up. And so I would continue to basically look at this going, well, we have this massive deficit, we have this massive debt, and I would say it's crushing debt because the interest is so high, we have to do something about it. Could we innovate our ways out of it? Possibly. You're seeing the AI innovation and what it's done to markets, because if you looked at the stock market, there's really only 5 stocks driving the whole S&P. But we're seeing that the economy as a whole has been the beneficiary of some of that. Will there be some blowback on that? Maybe. But you definitely see it. Could there be more innovation? More than likely, yes. Maybe that helps. But realistically, we need to lower interest rates, which is going to exacerbate the problem of affordability, and they're going to have that GDP runoff. But it has the one, the short term is it's going to at least have a positive impact potentially on our debt, as making it not such a huge line item. So again, if I was saying something to, if I was talking to somebody about what would the future hold, I would say you want to make sure that you are on things that fluctuate with inflation. So owning assets in a job, you might want to look at things that also fluctuate within inflation. And I'm not telling anybody go out there and be a realtor, but for example, as real estate prices go up, it forces up the compensation of somebody who's getting commissions. If prices of items and you're on a commission job or something, you're doing sales, it might benefit you. It might benefit you to be in some of those industries as opposed to somebody who's pure hourly, unless your hourly is somehow tied to the amount that the company is charging. So if prices go up, you sit stale. And this occurred recently when we had massive inflation, but it took a lot longer for salaries and wages to catch up to that. It wasn't growing at the same amount. So inflation's up here, wage growth is down here, and you're seeing a very big gap, which means people are really struggling as far as affordability. So if you're thinking, hey, what could I do about the future? You might want to make sure that you're working in things that are tied to that inflation as it drives up, because I don't see another way. Like, it's going to be a component of this. I don't see another way of avoiding that from occurring. You're going to continue to have increasing inflation, especially into this scenario, and especially with the options that were poised. So, one man's opinion. If you have different comments, or if I'm missing something, or you think I'm all wet, put it in the comments below. If you think somebody could benefit from this information, please share it, and like and subscribe.